Imagine a life where money no longer restricts your choices and you're in the driver's seat of your financial journey. That's not just a dream, guys. It's a reality I achieved as well as many of our clients, and now I can teach you exactly how to do that. Now, stay to the end for a key tip on where your passive income needs to be so it can get you there. All right, so number one, and this is my top 5 ways to become financially free. In fact, it's not just worked for me once, this has happened for me twice. So here's how I can do it. Number one, I knew my numbers. What's crazy is in both situations, I got just so focused on how much income is coming in, how much expenses are going out, right? Tracking that money coming in and out. Now, the first time I became financially independent, it was easy. It had low numbers. I was only spending $3,500 a month. So I therefore knew that $3,500 a month is what it was required in passive income to become financially independent. Now, I started tracking that money and it became better. Now, when it got more complex, the second time around, and the reason why it's second, it's not because I'm amazing by becoming financially independent twice, it's because I screwed up the first time. The recession kicked my butt. I went from millionaire to upside down millionaire. I was over $1 million in debt, had to dig back out of that hole. So just so you understand, I'm not coming from a place of judgment here because trust me, you've probably never been in a worse financial position than I've been in myself. That should inspire hope for you at least, because I had to go back to the same basics that I'm telling you again, which is again, tracking my money. I had to track those numbers. A great way to do that, I recommend using Mint. Mint is a great app to use and it's automated. It makes it easy to track it. It totals up all the money for you. You know exactly where you're spending money and how. And I'll tell you this, in my experience of working with hundreds and hundreds of clients, one thing I've noticed is that those that actually track their money, they will find at least $300 a month at minimum. Usually, especially if it's a business owner, they're finding at least $500 to $1,000 a month, not by changing their lifestyle, not by cutting out things that they love, but actually just paying attention to what's going on with their money, knowing it's there, not just looking at the balance of your account, seeing if you're going to run out of money. They actually pay attention. So that's very important to do, is start really tracking your money. Now, the next thing to do, you might be thinking, okay, Chris, where's that beautiful investment you're gonna talk about? Not yet. The next thing I would say to do is pay off your high payment loans. Notice I didn't say high interest loans, and notice I didn't just say low balance loans. There's the debt snowball, the debt avalanche strategy that you hear about all the time. But I actually teach a strategy that I've developed called the cash flow index. The cash flow index does this. You take the loan balance of that specific loan, you divide it by the minimum monthly payment that you're required to pay on that loan. So for example, you have a $10,000 credit card that you have to pay $200 a month on. 10,000 divided by 200 gives you a cash flow index of 50. Now let's just say you also have a $10,000 auto loan, but the monthly payment is $500 a month. Well, 10,000 divided by 500 is a 20 index. Now, if you take this index away, I know that's a lot of math sometimes, but if you take that index away for a second, just look at this. $10,000 credit card that's $200 a month, or a $10,000 car loan at $500 a month. If you want to be in a much better place financially, if you want to have more breathing room, right? You want to be able to breathe more easily by having less expenses. Which one do you pay off if all you could pay off is one? You pay off the car loan, right? You pay that off to free up the $500 a month. Because you can always take that $500, apply it to the other credit card, make it $700 a month, and you'll pay that sucker off in a year anyways. So even if it's higher interest, it doesn't matter. It frees up that money. And I'm telling you from my experience, especially if you're a business owner, income can go up or down, right? You can have great months, you can have bad months. Even in a normal life, even if you have a salary wage type of job, still things can fluctuate. You could have less money coming in one month than the other. You could have more expenses coming in that you didn't expect. All those things can happen. It's nice to know you don't have to keep paying that $500 a month. So that cash flow index is take that balance divided by the minimum payment and pay off the lowest index first. You pay off the lowest one first and then you work your way up. You do the snowball method, but you do it based on the lowest cash flow index and keep rolling it up. I will say this as a bonus. If it's above a 40, you might consider refinancing or do some other things too. Even with mortgages. Mortgages should have an index right around 150 to 200, depending on your interest rates. Those things are great. I like to not pay extra on those loans. Ooh, bonus tip. On your debts, don't pay extra payments to any kind of loans that do not go down when you pay them down. That means your car loans, your student loans, your mortgages. Do not pay extra payments on those loans. It frees up no cash flow, and all it does is put the bank in a better position than you because they get your cash and your cash is now gone out of your life. You only, if you're gonna pay out extra, pay it on those lowest cash flow index credit cards and things like that, that the payments go down as you pay them down. And going to the third thing, even though I gave a few bonus ones too, this is the third of the 5 ways I was planning on. Number 3 is build up your emergency savings, right? I don't want a rubber band effect in your life. What I mean is, when people don't have emergency savings, maybe they build up a little bit, but then they use all that savings. Maybe they use all the savings to pay off a loan. And this is why I'm saying it right now. They'll take all their savings and pay off a loan. I've done this. What happens is that inevitably, some emergency comes up where you want that money back. But the problem is if you paid it to a loan or something like that, you don't have it anymore. So you need an emergency savings account just for those very reasons. When those unexpected expenses come up or loss of income happens or something happens, you want that emergency savings fund to help you out. Heck, if we get furloughed or laid off again or everything shuts down because of another COVID type of thing, you want to have that emergency fund to give you that peace of mind. The problem is people, they'll build up the savings and then they'll spend it and then it shrinks again. If you don't have an emergency fund, your wealth can never grow. You're always stuck in the rat race forever. So that emergency fund, as unsexy as it is, right? Because you're earning maybe .nothing% in the bank account, it's still such an essential part of your financial health. You've got to have it at least 6 months reserves. And if you're a business owner, I'd even recommend going up to 12 months of your expenses, your monthly expenses that's saved up there so that you have enough just in case. Oh, another bonus tip. I know I keep giving them bonus tips, but a great way to save up the emergency fund beyond just .nothing% bank account is use infinite banking, which we've got plenty of videos on and a whole playlist on this channel about infinite banking. You should definitely check that out. All right, number 4 is then as you've got you know your numbers, you're tracking your numbers, you're paying off those highest payment loans so you get a better ROI in your cash. You have your emergency fund, then you buy cash flowing investments. Notice I didn't say go buy crypto, go buy stocks or mutual funds or options or anything like that. No, cash flowing investments. Those investments that increase your passive income and bring in more money each and every month. Notice that cash flow is the key thing here. Heck, I even love passive income, don't I? Right? I love passive income because I want you to have more income coming in. That is what makes a difference in your life. That's what gives you that ability to be free. Take buy those cash flow investments, and I recommend real assets. Don't go for the things that are really speculative in nature. You know, I definitely don't recommend people try to go for like this newest technology, the latest and greatest thing that you can invest your money into, or these startups or IPOs, you know, which don't pay cash flow anyways, or, you know, trying to invest in just, you know, cryptos and things like that. Like, stay away from those things. Invest in things that have been proven. This is why I love real estate. I can invest in real estate and make potentially double-digit returns in cash flow coming in. That's even better than putting my money in a retirement account. Another bonus. You probably want to avoid retirement accounts because they do not increase your cash flow at all. And especially if you want to retire early, you definitely don't want to be putting your money in retirement accounts. Now, once you've done that, you have cash flowing investments, reinvest the cash. Keep that money going, right? Take that cash flow you have, money that you've freed up from tracking your numbers, money from paying off your loans. You know, now you already have an emergency fund. You don't have to keep saving there anymore. You know, the cash flowing investment, the passive income from that, take all that money and reinvest to buy more cash flowing investments. You just keep reinvesting that money. Don't go and use this to buy your Lamborghini. Don't use this to go buy a bigger house. Use this to keep building your freedom versus building the bondage. You want that freedom there. Reinvest that cash and keep reinvesting it. Not just the point where you're financially independent, where you have enough to pay for your expenses. This is a bonus tip and very, very important from my own personal experience and also helping a lot of our clients do the same thing, is get your passive income at least 20% above your expenses. So that means if your expenses are $10,000 a month, you want it to be at least $12,000 a month of good, stable, predictable passive income coming in. If your expenses are $5,000 a month, get it to $6,000 a month. Just get it above and beyond. When I became financially independent the first time, right? I mean, I only needed $3,500 a month, but I didn't get to the point where I started making decisions about what to do with my time until it got to about $5,000 a month. I made sure it went above and beyond that just to give me that buffer. And especially with inflation, depending on how that's gonna look day to day or week to week, you really wanna make sure you go above and beyond so that you still have extra to keep reinvesting and continue to build your cash flow so that you become not just financially independent once, but financially independent year after year after year after year. That's the important thing. Guys, I hope this is helpful for you. If you thought this is great, I also want you to watch this next video, which is what is the difference between passive and active income? So important to know when you're trying to create passive income. Check that out.